We have experienced the biggest health and economic event in recent times. Despite this, the housing market has been on a huge upward swing, and many are asking how long can this trend really last? Is the housing market in a bubble in 2021? Can housing prices accelerate this fast forever like they have over the last year? In this video, we will discuss some of the points that people are making for why we are headed into a market crash in 2021, and what you can expect to see for the housing market throughout the rest of this year and in the near future. Be sure to watch this video until the end for the full details. The unemployment rate remains extremely high. According to the Bureau of Labor Statistics, the real rate of unemployment, which is the U6 rate of unemployment, is 11.7%, which is still an extremely large number. The U6 unemployment number takes into consideration the unemployed, the marginally attached, and the discouraged workers, which is why it is higher than the rate that the government reports, the U3 unemployment. This is a large number of people who are unemployed and in many instances are having a hard time keeping up with their bills. Imagine the strain that this will put on people's ability to pay their mortgages. This can be seen firsthand in the forbearance rate. People enter into forbearance when they have difficulty making their monthly mortgage payments. This gives the homeowner a break in their mortgage payments while in the program and while they are having financial difficulties. While they are in the forbearance program, these homeowners defer their monthly payments and don't have to pay them at all for the time being. Once they exit forbearance, the thought is that the balance due will be tacked onto the end of their loan, so they will not have to come up with this money up front. While this is believed to be the case, we will not know the reality of how this will exactly work until forbearance comes to a close. The government created this program with the CARES Act and when the pandemic first started. There are 2.8 million people in forbearance, or 5.54% of mortgages, as of December 1, 2020, according to the Mortgage Bankers Association. These are all people who have gone into the forbearance program and told their lenders that they are having financial trouble and can't pay their mortgage. Many experts are predicting a wave of foreclosures in the near future. What would it do to the housing market if all of these homes were to go on the market at the exact same time? Well, if demand were to stay the same and a wave of housing came onto the market at the same time, then the value of homes would take a significant hit in the process. This could be seen most recently in 2008 and near after when the demand for housing declined as the number of houses hitting the market increased drastically, with the high number of foreclosures hitting the market. So many are asking, are we facing another 2008 in the near future? To that I would say not so fast. There are many other things that we need to consider before coming to that conclusion. First is the supply versus demand of what we are currently seeing in the market today. In the current housing environment, there is an issue with supply that is causing there to be less supply of housing on the market than there otherwise would be. People are unwilling to put their home on the market and have people walking through their home during this health crisis that we find ourselves in. This is causing there to be less of a supply of homes coming on the market while demand remains strong. As a result, home prices have been rising significantly. There is also a huge deficit in the number of houses needed in the US in order to meet demand. According to Freddemac.com, in 2017 they estimated that we needed to build an additional 370,000 houses per year just to meet the demand for housing. This is only the number of houses for that year in order to catch up with the demand needed on a per-year basis and does not take into consideration the huge deficit in housing needed for a number of years before that. As the price for materials that go into building a home continues to soar, so does the cost of building a home. Builders are finding it to be increasingly more difficult to supply the population with affordable housing that is desperately needed in the United States today. People are wanting to move to less populated, spread out areas. With the current state of the environment, people are seeking areas where they are further spaced out from their neighbors. This is translating into higher demand for housing in certain areas of the country. In those areas, housing prices will rise more quickly due to this increase in demand, while in areas with more dense populations, we are seeing people moving and home prices being negatively affected. Another thing to take into consideration is the historically low interest rates that we are seeing today. This could be a reason that would entice certain people to move to a house they find more desirable or an area that better fits their desired lifestyle. Either way, this would create more demand for housing, further increasing the price of homes today. When people make large purchases that they have to finance, they make those decisions based off of what their monthly payment will be. Since interest rates have dropped to historic lows, people are looking to take advantage of this perhaps once-in-a-lifetime opportunity. As you probably have seen, many have been racing to refinance their house for those individuals who are wanting to stay put in their current home. Others are on the search for a home they find to be better suited for them in their current needs. With interest rates lower, home buyers can buy a bigger home or in a more desirable area for the same monthly payment that they were paying before. The previous things that we discussed point out the massive amount of demand that we are experiencing in this current environment, which is translating into soaring home prices. This is demand that could very well ease the number of foreclosures that will inevitably hit the market in the future. But will that alone be enough to stop housing values from crashing like they did in 2008? Well, that will likely depend on a few very important factors that should not be overlooked. Foreclosures take a long time to process. Foreclosures can take a year, maybe more from the start of a foreclosure to finish before they actually enter into the market. This gives a lot of time for individuals to make improvements to their situation and find ways of getting caught up on their payments. Banks have learned their lesson from the financial crisis of 2008. They lost a lot of money foreclosing on houses and getting back 50% or less of what those homes were originally worth. This time, they are far more likely to go back to the borrower and renegotiate terms with them in order to keep those families in their homes and keep payments coming into their bank as well. After all, a bank is a business and they are in the business of generating revenue, not losing money. If that is not enough, the government is likely to keep extending the forbearance moratorium for the foreseeable future. With the uncertainty of the current economy, the government will likely continue to extend forbearance for people in order to get them back on their feet so they can start making their payments again. I foresee them doing this for a while longer until it looks like the economy is actually starting to recover. Who knows what measures they will look at or when they will decide that the economy is strong enough to end the forbearance program, but the probabilities point to it being around a little while longer. Lastly is the big investors who are waiting on the sidelines with cash for a large number of foreclosures to hit the market. These investors will act quickly and be able to scoop up a number of these foreclosures to put into their portfolios. With the number of properties that they will be acquiring, it will leave enough for a healthy inventory level for the housing market. This means that the amount of inventory actually hitting the market will be lower than some expect, and home values will not be as affected as some would be led to believe. So, will there be a massive discount in home values like there was in 2008? Probably not. If that is what you are waiting for in order to buy a home today, you will be waiting a long time. The probabilities point to housing values leveling off when forbearance ends and foreclosures start hitting the market. During that period of time, home prices will stay stagnant, or best case scenario they may dip slightly. Although it is likely that home prices may level off in the future, we will not see this in 2021. The government has now extended the forbearance moratorium through June of 2021. With this protection, families can enter into forbearance by the end of June 2021 for a 180-day period. At that time, if they are continuing to have financial trouble, they can extend it for another 180 days. This means that someone entering into forbearance at the end of June 2021 may continue to be in forbearance until July 2022. The government will most likely continue to expand forbearance and kick this can down the road, and we will likely not see the impact to home values that we are expecting for years to come. If you have enjoyed this content, please don't forget to like and subscribe to the Investor in You channel and share this information with your friends. By doing so, you will be helping to bring this valuable information to people who need it in order to make more informed decisions.